Hello and good evening. Hello, everyone. Hi, welcome to FSMOne's webinar. We'll be starting in a while. Okay, a very good evening and welcome to another FSMOne event. First of all, thank you all for participating today. My name is R. Bhushan. I am the client investment specialist from FSMOne. And today's topic is structured as such. First, our speaker for today will be giving his talk and presentation. And along the way, if you have any questions, please feel free to type your questions in the Q&A tab, and our speaker will address all your questions at the end of the session. The topic for today is Shariah investment opportunities in Asia Pacific ex Japan, presented by Mr. Ajay Sharma, Head of Equities Absolute Return Strategies from Maybank Asset Management Singapore. First, allow me to introduce our speaker. Mr. Ajay is the Head of Equities, Absolute Return and Portfolio Manager at Maybank Asset Management Singapore. He has over 31 years of experience in bottom-up stock picking across multiple sectors and countries, with strong sector expertise in consumer, healthcare, materials, technology, and industrials. Prior to MAMS, he was a buy-side sector specialist at Legg Mason Asset Management, which was previously known as Citigroup Asset Management, responsible for the Asian technology, industrials, internet, and healthcare sectors. He was also previously a sell-side IT analyst with DSP Merrill Lynch and sell-side IT consumer and metals analyst with Morgan Stanley. Mr. Ajay graduated second in the institute with an MBA in finance from the Indian Institute of Management, bagging a gold medal for best performance in finance. He also holds a BTech in electrical engineering from the Institute of Technology, and he's also a CFA charter holder. With that brief introduction, let's welcome Mr. Ajay. Mr. Ajay, the floor is yours.
Okay. Good evening, everybody. So thanks for the introduction. So I will walk you through what are the investment opportunity in the Shariah space in Asia Pac, ex-Japan, and to highlight that, basically, I'll, I'll talk about the fund I manage and advise on Sharia fund. So if you go to the next slide. Okay, so this fund has been running for last 9 years or so, and this is basically invest in all Asian markets, including Japan. And the idea is to capture the growth potential in Asia, and basically, since we are a regional uh, fund management house, basically being based in Singapore, we can tap into all the countries, I think, because the corporate access is quite good in Singapore, and so we are able to basically take advantage of opportunities across 8-9 countries, basically, which includes China, India, Indonesia, Malaysia, Singapore, Taiwan, Korea, and Thailand. And if you go to the next slide, basically this is the track record of the fund. As you can see, year to date, the fund is significantly outperforming the benchmark, and it's also done quite well compared to the benchmark, both on 1, 3-year and 5-year basis. And if you go to the next slide, basically it shows that this fund is in the top quartile consistently, and has also won awards from FSMOne. So if you go to the next slide, basically I will highlight how we are positioned and where we see opportunities within Asia. So this fund has a significant overweight position in India, and that's the country which is more domestically focused and is not really impacted by all the turmoil we are seeing globally. and specifically in certain sectors such as healthcare, consumer, and industrial, which is more capex oriented. We are seeing strong earnings growth and good growth potential. So we are finding a lot of opportunity in that space. Similarly, other domestically focused countries like Indonesia, we are finding opportunities in the consumer names, and we also find opportunities in China in select sectors. Overall, the economy is not doing that great, but in certain specific sectors such as oil and gas, telecom, and internet, we find a lot of beaten down stocks, and some of them offering pretty strong dividend yields of upwards of 7 to 8%. So country-wise, India, Indonesia, Thailand, and China. These would be our major overweights. Korea is a big overweight in the benchmark, but Korea, as you know, has a lot of stocks in the technology and auto space, which are more exposed to the global macro. And our base case is for a recession in US sometime later. And so we are underweight Korea, and similarly we are underweight Australia as well, because it's again mining heavy, and those stocks are also exposed to a slowdown in the global economy. So if you go to the next slide. Yeah, these charts just show you the divergence in terms of the two markets, basically Asia and the US. Uh, 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 Basically, the Asia has significantly underperformed the US market, and I think later on we'll show more charts. But basically, now in terms of valuation, Asia is trading one standard deviation below its mean. It's almost more than 30% discount to US market, which is trading at its mean. So I think in that sense, on a relative basis, Asia offers better value compared to the developed markets. So if you go to the next slide. Yeah, this we talked about briefly, but here I've listed down the sectors where we see ideas in these countries. So within India, basically healthcare is an important sector, because there are a lot of companies which focus on the branded drugs, and they are seeing growth because of greater incidence of chronic disease, and also because of rising incomes. People prefer to buy branded drugs over generics. So we own quite a few healthcare companies such as Sanofi, P&G, Procter and Gamble Healthcare, etc., which basically benefiting from this trend. Similarly, capex theme is a very powerful theme in India right now, because government is spending a lot of money on the infrastructure, building roads, railways, ports, transmission line network, as well as renewable energy space. So, a number of companies which are actually either doing construction work or providing equipment to these sectors, they are seeing strong order books and strong earnings. So we own quite a few names in that space. Uh, in Indonesia, basically the mid to high end consumption has been very strong after COVID. So some of the companies we own basically are reporting revenue growth of upwards of 25 to 30%, and seeing strong earnings growth as well, and uh, still trading at pretty reasonable low to mid teens valuation. So we find them as attractive opportunities. In Thailand, basically, I think the market has done very poorly over the last 1 year, it's down almost 20%. And basically because it was hit by lack of tourism, lack of tourists coming from China, which was a big major market for Thailand tourism. But now there has been a rebound in that, and as well as now government, with the new government in place, they are going to give out handouts to boost the economy. So that will also lead to revival in the consumption demand. So again, we own quite a few consumer names and also some auto component names, which basically are seeing increased market share and because a lot of global auto companies are focusing on Thailand as a major supply chain hub. So basically, so overall, we like names within the consumer space in Thailand as well. And in China, I think economic recovery has been weaker than expected, uh, but the market has done very poorly, and so over last 2 years, markets have been down quite a bit. And so we find attractive names in the telecom, internet, and energy space. As I said, companies like, means we'll talk about some of the names later, but companies like China Mobile or CNOC, which are like offering dividend yields of 7 to 10%, and also showing growth. So I think, and they are defensive as well. So we feel that basically there is potential to make returns on these stocks. So this is broadly a summary of where we see opportunities in which countries as well as in which sectors. And then on the next slide, we have listed down some of the names within these sectors and countries. So Map Active is a sportswear retailer in Indonesia. As I said earlier, this company is valuation. So, and they're also expanding number of stores regionally, not only Indonesia but also in Singapore, Malaysia, Philippines, Thailand, and also signing up with more brands to set up stores. So there is a lot of growth potential. And then in China, we have Alibaba and CNOC. So CNOC is the oil company. So it's trading at like 4 5 times price to earnings, and dividend yields are more than 10%. And it's kind of pricing oil of about $50 to $60, whereas oil is still at $80. So there is a lot of margin of safety in this company. And Alibaba again has been beaten down over the last 1.5 2 years, and now trading at almost single digit price earnings. So I think with a little bit of recovery and also spin off of its different businesses as separate listed companies, we feel there will be value unlocking and possibility of good returns going forward. And then we have some names in Thailand, which is Epico, is an auto component company, basically selling auto parts to likes of Isuzu or Toyota and the Japanese majors. And this company is basically seeing increased market share, and the valuation is like 5 6 times earnings. So I think despite whatever slowdown you might see, I think this company is growing because it's gaining more business and more market share from their existing as well as new customers. So, and the valuation is already discounting a significant slowdown globally. Similarly, Sanofi, I talked about, this is a multinational company, subsidiary of multinational company in India, focused on the branded drugs, and seeing strong growth because of the factors I talked about earlier, and also margin expansion because the raw material prices have come down, and at the same time they're able to increase their product prices. So they're seeing strong earnings growth. And then TSMC is the Taiwan foundry. I think this is one of the names we like within the tech space because they basically have all the major technology companies as their customers. And you all would know that Nvidia is seeing very strong growth because of the new AI chips, and TSMC is the major supplier for that. And so I think this whole AI boom would basically TSMC will be one of big beneficiary. Again, the stock had come down quite a bit and only rebounded recently, but it also offers decent value at the current price. So I think these are our top 10 overweight positions, and this just gives you an idea that a lot of them are non-benchmark stock, and really each one of them have their own investment thesis. And I think now we'll talk about basically how we go about selecting stocks and how we go about basically getting an edge in identifying opportunities and generating alpha for our clients and investors. Yeah, this is again a snapshot of the fund performance. So you can see fund is in the top quartile year to date. Next slide. Yeah, so now I'll talk about the investment process. So basically, our portfolio construction starts with idea generation. So for each sector in different countries in Asia, we look at basically we have some interest and we monitor the prices on a daily basis, and then we look at various ratios such as price earnings to book, price earnings to growth, and also we remain cognizant of any particular themes which might be playing out at a particular point of time. So, for example, I talked about the capex theme in India as an example. So then, if we have a theme, then we look for ideas within that to play that theme as. And once we shortlist stocks, then we basically do detailed analysis. So for each company we look to put in the portfolio, we will talk to the management, we'll talk to the brokers, we'll talk to the competitors, and then we'll build a financial model which will have a detailed P&L, balance sheet, cash flow, and then we'll come up with a estimate and basically a valuation and a target price for each stock which we want to put in the portfolio. And based on our conviction, how confident we are about the return, we will size the position. So for a higher conviction, we will go almost anywhere between 3 to 5% overweight. Medium conviction, we might be 1 to 3%. And then based on, so we do it sector by sector, the same process, and that's how we come up with ideas. And all the stocks we showed you in the previous page basically is a function of all this work we have done. And that's how we construct this alpha portfolio. So if you find that India is our biggest overweight, it is a function of the fact that we are finding a lot of ideas in India because of the strong growth of the in the economy, as well as certain themes playing out. And it's a dynamic thing; it can change. If you find that the stocks are no longer cheap, then or have hit our target price, then you will find that the weight might come down. So it's a dynamic process which we follow day in, day out. So go to next slide. Yeah, so this basically I talked about briefly. So the fact that I have personally have experience of more than 30 years looking at certain sectors and countries also gives an edge in terms of coming up with ideas, and the fact that we have knowledge of uh, which companies and which stocks are doing well at a particular point of time in various countries. And then that basically then we have this done this dirty work of building financial model over the last 30 years. So it makes the job easier basically, because uh, basically a lot of our peers actually not able to do this because they have tended to rely on the brokers for their stock picks. And I think also having our own valuation gives us an idea at every point of time whether the stock is overvalued or undervalued, and uh, whether we should be buying or selling at a particular point of time. And then also the market is so volatile, so once you have your own valuation and your own earnings model, you can take advantage of the volatility in the markets. Because a lot of times people might panic and the stock gets oversold, and basically people just sell without really looking at the fundamentals, I think. But at that point in time, we can focus on the fundamentals and the fair value, and then take a long term view and take advantage of the correction. We go to the next slide. So basically, this just highlights where we get an edge. So you can see Asia has almost 20,000 stocks, and I guess the brokers are not covering more than maybe 200, 300 stocks. So there is a lot of stocks which has no coverage or very limited coverage, and especially if the lower the market cap, the lower will be the coverage. So if we are doing our own screening and our own work, then we can identify a lot of the opportunities where basically practically nobody's focused on. And then also basically having sector insights and covering basically companies in a particular sector across different markets, we can identify if a particular stock within a particular sector is underpriced, overpriced, because we are looking at across countries. So it could be any it could be any consumer company, healthcare company. We tend to look at valuation across markets, and we can identify for similar type of business whether there is any mispricing. And then, as I said earlier, we can take a longer term horizon once we have our own valuation and earnings forecast. So I guess the bottom line is the a lot of our competitors basically they are uh, really depending on more on the brokers, and so if the broker changes the view, that they also then they don't have their own conviction, and then they tend to follow the brokers, and then that basically a lot of times brokers are kind of changing views at the wrong time actually, and they if you do that follow them, then obviously you lose out on a lot of alpha. So I think following this process and all these factors I talked about gives us a strong competitive edge in generating consistent alpha. Next slide. So in terms of our stock picks, they typically fall into two buckets. We what we call as GARP, which is growth at a reasonable price. So these are typically companies which are growing on a secular basis, have strong competitive advantage, and are trading at reasonable valuation. So some of the healthcare companies or consumer companies would fall in that category. And then we have value picks, which are companies really trading at very tough valuations, either on price to book or price earnings, and also giving decent dividend yields. So some of the energy stocks and telecom stocks in China would fall in this category. So I think typically our focus is more on growth, but uh, if we find value opportunity, we also take advantage of that. I think so. We are pretty agnostic, but in Asia, I think typically the focus tends to be because Asia is obviously growing at a faster pace than developed markets. I think the focus tends to be more on the growth side. Next slide. Yeah, so I think I talked about it basically the fact, the experience, strong industry company knowledge, and the fact that we rely on our own research rather than the brokers for stock picking gives us, yeah, I think that pretty much sums up in terms of the opportunities and how we go about it. And then maybe I will, if you have any questions on the outlook and how we see the markets overall. Okay, so maybe we can move on to the outlook. Next slide. So I guess I'll show you charts later, but basically Asian markets have performed very poorly over last 2 years or so, and even the currencies have depreciated. And I think the general concern, obviously, the Chinese economy was very weak. I think the property markets, the property is a big sector in China, almost 20% of GDP. That really was property sales were down almost 30-40% a year. So, and then there was obviously government intervention in the internet sector. So that also caused a lot of headwind for the big companies in China. and then you had the Russia-Ukraine war and a lot of geopolitical tensions. So basically, Asia market obviously saw a lot of selling by foreigners, and obviously the markets did not do well. But we'll show you charts later that the valuations are really bottomed out, and while the volatility will continue, but in terms of at least in terms of fundamentals, things are pretty okay actually. The China, while the recovery has been weaker than expected, but there are pockets of growth. I think especially in the consumer sector, even the auto sales are not bad, and the government is now focusing on a lot of stimulus measures which should help achieve GDP growth of 5%. Uh, and then I think other thing is that the interest rates in Asia versus the West, basically we'll show you charts later that the inflation is basically come down in Asia at a faster pace, and the rates are also lower, and that's why you're seeing actually currencies depreciating, because obviously the US rates are higher than the Asian rates, something we have not seen earlier. But that bodes well for the economies if the rates are lower. Uh, so I think the fact that the markets have not performed and the economic recovery is picking pace, and basically the fact that interest rates have peaked, inflations have stabilized, I think is basically bodes well for the Asian economies. So if you go to the next slide, yeah, this just tells you, like, if you look at Indonesia and Malaysia, for example, uh, you can see the current inflation is lower than the historical average. So, and even India, this chart is a bit outdated, but even India inflation has come down. So basically, the inflation is pretty benign, and I think uh, the central banks would they're watching actually, and if oil prices have also come off actually quite sharply in the last 1 month or so. So if and recent data I saw suggests that the oil supply is increasing faster than the demand. So that also good news for oil dependent Asian economies. Next slide. And if you see the US inflation also, the core inflation has also started to drop, which is a basically positive factor for future interest rates. Uh, and if the US interest rates start dropping, then obviously that will be a positive catalyst for the emerging markets in general. Although we are not factoring in at this point in time, but at least the inflation data is pointing in the right direction for the future interest rates. We go to the next slide. So yeah, so this just shows you how the divergence basically between the developed markets and the emerging markets, and how Asia basically US has done very well, but Asia has done very poorly. So now Asia had a much lower valuation. Also, the growth potential is higher. If you go just by the past GDP data, you can see most of the economies, even currently, most of the economies are still growing at 5% plus. So uh, I think the markets are quite pessimistic, and I think that's been really. I think whenever people worry about global recession, I think it's and higher interest rates, stronger dollar, I think is the emerging markets which get hammered, and that's what we are seeing. But that's something which will not keep continuing basically, and so once you have more comfort level on the future interest rates, I think future interest rates will next slide. So there's some slides basically on China, how basically basically people are quite pessimistic. As you can see from China, the markets are down again 10-12% this year, but the data is not so bad actually. If you see, the auto sales are increasing, retail sales are increasing, uh, and we will show you later. Basically, it's a two-tier economy. If you go to the next slide, I think that consumer confidence is rebounding. Of course, still a long way to go before it's the pre-COVID level, but uh, at the margin, I think things are improving. And if you go to the next slide, yeah, I think so. What's our base case? Basically, our base case is that there will be mild recession in US in first half, and I think Asia obviously will not be immune to that, but it'll be more resilient because of basically the interest rate might start to come off, and also as you've seen, our portfolio is more focused on the domestic oriented stocks. So to that extent, we are basically consciously building that recession in the portfolio scenario in the portfolio, and trying to avoid stocks which might get more impacted by this recession scenario. And in China, obviously, I think last 2 years have been bad, but at the margin, things will get better. And if the government sticks to its achieving the 5% target, then uh, there will be pockets of growth within China, and we basically will try and capture that in our portfolio. And I think I talked about the domestic focus, particularly in the stocks in India, Indonesia, and also the fact that the valuations are quite attractive, one standard deviation below the mean. So yeah, overall we feel that basically I think markets might remain choppy, but if we are entering at current point of time when the markets already performed poorly, and a lot of the basically fears regarding recession and dollar strength and depreciation of the Asian currency is kind of getting priced in the stock markets. So if you can take a slightly 6 to 12 months view, I think you will benefit from the rebound. Yeah, so I think this you can see that the services is doing better than the manufacturing, because obviously manufacturing is more geared towards exports, and obviously there has been a slowdown globally uh, because of the higher interest rates. Next slide. Yeah, this just basically gives some slides on how the consumption expenditure is booming in the domestic centric economies, and how they will be more insulated from recession. And again, I think um, not every sector will be insulated, but I think by focusing on the stocks which sell mostly in the local economy, we can avoid the risk of impact of the global recession. Next slide. Yeah, this again pretty much the similar kind of chart. Basically, it's shows you that the valuations are towards a trough, and I think particularly the valuations are very very low in China, and even ASEAN, and they are the higher like that. We are more positive India, ASEAN, and China, and less so in Taiwan and Korea. And in fact, we are seeing some upgrades in China, whereas we are seeing downgrades in terms of earnings in Korea and Taiwan. So that's pretty much also reflecting the global slowdown, because both Korea and Taiwan more exposed to slowdown in US and developed markets. So this just chart from which shows you the history over certain cycles, how Asia outperformed from 2000 to 2008, and then last 12, 15 years has been underperforming. And it was difficult to predict, but maybe going forward we can see uh, if the recession is mild, then maybe then I think there is a greater chance that Asia will outperform the developed markets, because a lot of the selling which you're seeing from the foreigners, that will turn into buying once people have more confidence in terms of uh, rates going down in future. So the gap, basically valuation gap, is at extreme levels. I think that's what you can see, and that's on a rating basis. Asia is basically looking much attractive compared to the developed markets. I think that's pretty much. Yeah. So I think then you have some data about the fund in the appendix, I think, but basically it's a Shariah fund, and basically the idea is to capture growth in Asia, and most of the times we don't keep much cash, and most of the times we are fully invested, uh, and we try to find ideas based on the process I described earlier. So it's a pretty much bottom up stock picking portfolio, and kind of benchmark aware but benchmark agnostic. Okay, so that's all I had to say, and happy to take any questions.
Thank you, Mr. Ajay, for the insightful presentation. We will now go on to the Q&A session. So, dear all, you can actually use the Q&A session to ask a question. Let's start off with the first question, right? What do you think, Mr. Ajay, what do you think of the stimulus from, no, why do you think the stimulus from the Chinese government will help its market? Why do you think the stimulus from government of China will help its market?
Yeah, I think basically what you're seeing is that the consumer is doesn't have confidence right now to spend, basically, and the consumer is not spending at levels they were spending before COVID, basically, right? And the main problem in Chinese economy is the property sector. I think again the sales are down by almost 40% last year, and this year is again not looking that great, right? So there is a crisis of confidence, and I think government has to do is to make things easier to for people to purchase properties. For example, make relaxations in, for example, getting mortgage, or buying second house and things like that. So there may not be stimulus. Also, I think it can be just a relaxation of certain policies, which makes things easier and gives confidence to consumer that okay, things are stabilizing and prices will not go down further. I think so. There is a lot of pent up demand, but people don't have confidence. Nobody wants to buy when you think prices are going to go down more, right? So that is one factor, and I think they also don't want to do blind stimulus like they did in 2008 and all that, because that also leads to excesses. So they are doing pretty calibrated stimulus, and that will bring confidence both in the business as well as the retail community to spend actually and invest, and that will kickstart the economy. So I think that's how we feel that if the government basically puts gets its act together and puts focus on areas which need their support and certain relaxation policies, things will look up.
Okay, thank you for that answer. A follow-up question on that. With the looming property crisis in China, what will be the catalyst for the China market to rebound? Will the stimulus from the Chinese government help to mitigate this?
I think the rebound is a function of the expectations are very low, basically, from the market participants. So they are not expecting any growth. In fact, they're expecting degrowth also. So we have seen that in that scenario, even if the company comes up with a little bit of beat or just in line numbers, not as bad, then the stocks actually go up. And I think the market heavyweights are really the internet stocks like Tencent, Alibaba, and all those. And they have been actually actually they have been beating numbers, but the foreigners have been selling, and that's because of geopolitical tension. So it could be even a little bit of relaxation in the geopolitical tension between China and US. So it's a sentiment issue. I think the numbers are, for a lot of companies, the numbers are not fallen off the cliff. I think they are maybe not growing, but the numbers are still stable to slight growth, right? So, and the valuations are at the extreme bottom. So it just requires a little bit improvement in sentiment, I think. And I think at the margin, slight improvement in growth, slight relaxation, geopolitical tensions is all it needs for the markets can rally even 15-20%, because the markets are very, very oversold and valuations are very, very cheap. And I think the growth is, I think the numbers are not falling off the cliff. Basically, the numbers are worst case for the large companies I'm talking about. The numbers are worst case single digit growth, but they are not like declining. So it's more pessimism, I think, and it's, a lot of it is also got to do with the geopolitical situation where the foreigners are completely bailing out of the market. So I think at some stage that also will settle down, I think, because whoever wants to sell is already sold off.
Thank you, Mr. Ajay. The next question is that does the fund invest in Malaysia? And if yes, how much, with, and why?
Sorry, come again.
Does the
Couldn't hear you.
fund invest in Malaysia? If yes, how much is the fund weighted in Malaysia and why?
Okay, the fund has, I mean, fund can invest in Malaysia, but since a regional fund, we find generally the stocks in Malaysia uh, are more expensive than what we find in other ASEAN or even other countries. And I think it's a function of how Malaysian market is, because it's a lot of scarcity premium in Malaysia for a lot of stocks, and also a good local investor base, right, which keeps the valuation high. Whereas for example, in a lot of ASEAN markets like Indonesia, Philippines, you don't have such a strong local investor base, and the valuation tend to get hammered down whenever there is foreigners selling. So I think our Malaysian weight is like maybe 2% or something like that, I think. Uh, so we don't find that many exciting opportunities in Malaysia on a relative basis.
Right. Thank you for that. The next question is that are your views likely to, sorry, let me rephrase that. Are your views likely to change over the period, or we sell out after reaching the target price?
Okay, so our target price is also a dynamic number, because it's also moves with the move in change in earnings and also change in the year, right? So if I start today, I might look at earnings for next year and build my target price. But if I'm next year, middle of next year, then I will might be looking at 2025 earnings, and this is typically, I'm talking about growth companies where the earnings are growing. So I guess, so the target price is not something which is fixed. It can also change as we move ahead in time, particularly for growth stocks. So we can constantly evaluate that, and sometimes the stock might go up so much that it might uh, basically factor in the growth even for next 1 or 2 years. In that case, if we feel it's overdone, then we might just get out of the position. But otherwise, we might continue to hold if we think the growth is taking care of the movement in the price. So it's pretty dynamic process, and we for each stock we have in the portfolio, we are constantly updating our numbers and target prices and keeping tab of that basically.
Okay, thanks for that. The next question, Mr. Ajay, is that usually we are advised to look at unit trusts as an investment for a longer time frame, say 3 to 5 years or more. So based on this, what will be the holding period like for the fund if an investor is interested to invest now?
Yeah, I think that I mean, I guess for us also, it's we prefer if people stay in for a longer period. That's how they get the benefit of compounding of our stocks, and also not end up selling when the markets are bad, markets are choppy. So I think we invest on that basis, and we prefer our investors also look at it on that basis. So most of the stocks we buy, basically we buying good businesses trading at reasonable prices, and hoping that the we get compounded returns from holding on to those stocks. So if we basically like the story, and we remain invested for a long period of time, as long as the valuations don't become too rich. And people who stay invested in the fund will definitely get that benefit if they also remain invested for a longer period of time. So yeah, I think we
Yep,
prefer longer holding period.
yep. Thank you. That's also a view from FSMOne that it's investment for a long period of time and not to do for short-term trading. So the next question is that if the USD strength remains longer than expected, will your strategy stay change much with regards to country positioning within Asia ex Japan?
So you're talking about US interest rate, is it?
Um, I think the question is more on the currency. Yeah, there's also on the interest rate.
Oh,
If
US
the
dollar.
USD,
Okay,
yeah,
okay,
US
okay.
dollar
Yeah, yeah.
strength remains
Okay.
longer. Yeah,
So actually, for us, we are not so concerned about currency as far as investing is concerned. I think because most of the stocks we're buying, basically, we expect the local returns to offset the currency depreciation, and still give us a healthy return. And the currencies don't depreciate like more than typically don't depreciate more than 5-7% in a year, whereas we are targeting 25 to 30% return at least on the holdings we have. So we don't worry so much about currency as far as the returns are concerned.
yeah. And somewhat related question to that is that what do you think the do you think the valuation gap between USA and Asia since 2008 has widened? And what do you think needs to happen for this gap to narrow? So the valuation gap between USA and Asia since 2008 has widened. What do you think needs to happen for this to narrow, for this gap to narrow?
Yeah, I think generally people need to. I guess it's also a function of the interest rate. Basically, the interest rates have gone up so much, right? So, and obviously that led to dollar strength. So indirectly, while we don't worry about dollar in that sense, but indirectly it does impact in terms of foreigners sell out of the emerging markets when that happens, when dollar strengthens. So to that extent, once your interest rate, people feel the interest rates are peaking, once that happens, and that in that sense people will come back to the emerging markets, I think. And I think China also, if the China also stabilizes and the geopolitical tensions between China and US basically improve, I think, which there is a slight possibility it might happen actually, then that also can change the sentiment. Uh, but yeah, I think the tough to say the timing, but I think directionally we are kind of hitting trough in terms of that. I think it's kind of all the factors pointing out that the it's overdone actually. That sort of differential, and things are not so bad out in Asia in terms of fundamentals.
Okay. Next question is that will the increasing global interest towards ESG friendly investments favor the developed markets over the emerging markets?
Yeah, I think that is true because obviously the ESG matrix is the developed companies obviously have a better track record. But I think, I mean, frankly, that kind of thing was quite hot maybe a few years ago, and it's not as hot at this point of time actually. At least people are, well, I think at a point of time people are not investing in oil stocks or coal stocks or anything which has any issue. But now I think, at least I don't find that to that same extent. So out in Asia, I think again people frankly invest where they see return potential. I think ESG is a factor, but it's not the overriding factor in my view. If the differential is so large, then I think that factor becomes a secondary factor, frankly.
Okay. Thank you for that. And the next question is that on India actually. So India has been one of the top performing markets over the past 2 years. Is the market too overvalued? Are there still any opportunities there? And are you planning to add in more overweight in India stocks?
So as you know, India has got a lot of depth actually, and if you look at the sectors and the stocks also, I mean, which perform also rotate from time to time. So in one year you'll have banks doing well, another year you'll have consumer doing well, one year you'll have capital goods doing well. So I think again it boils down to stock picking, and I think uh, we also able to identify reasonably priced stocks even today. And I think that will always continue because I say even India has like 5,000 plus stocks. And again, the coverage is not that great. So you'll always find opportunities which are reasonably priced and a lot of companies which are emerging actually. So I talked about this capital goods sectors. There's so many companies which are suddenly seeing very strong growth, almost 50-60% growth, very strong order books. And this is not just 1 year phenomena because as India has a lot of targets in terms of infrastructure development. So I guess we are not short on opportunities in India. And obviously we are cognizant of valuation, but we don't really look at the headline valuation because a lot of the big consumer companies are, for example, companies like Hindustan, Unilever, or Nestle, and all those multinational. They're trading at very high valuation, but we don't have any exposure to that. And some of the times those they distort the market valuation. But if you go on a bottoms up basis, you can find opportunities which are reasonably priced with a decent growth. And I think in terms of our overweight, again, it's a function of if we find more ideas, our overweight will increase. If we don't find ideas, then and some of our ideas work and we sell, then the overweight might reduce. So it's really very dynamic thing. But at this point in time, I think our overweight, we are finding ideas, and so our overweight might increase. And I think the recent results have been quite good also for a lot of companies. So at this point in time, we are looking to increase our weightage in some of the names we already own.
Thank you, Mr. Ajay. Uh, just a couple of few questions before we end the session. And the next one is that with the AI drive, with technology and AI driving the growth now and also in the future, are you planning to increase more in technology sector stocks compared to the current allocation in consumer discretionary materials and energy?
I think some of the names basically I think basically there is actual growth and there is in Taiwan, which are basically assembling chips rather than doing any high tech work. Companies like Quanta or Compal or whatever. I think they are trading at very high valuation compared to the history, like almost 2 to 3 times what they have traded, and these are pure assemblers, right? So we're not so keen on that. But I talked about TSMC. So I think we might increase exposure in TSMC, for example. Uh, and we're always on the lookout, actually. If so, it's not that we are not looking at the theme or whatever, but I think we don't just go on the hype. We go more on the fundamentals, whether wherever. So there are not many companies like Nvidia or TSMC really. Or you have so the AI theme, the big beneficiaries really are in the US market, and Asia is kind of catching more on the low end of it. So we have to see how sustainable, because it become very competitive as well. And today, because there's supply shortage, the margins are high for even the assemblers. But we have seen that time and time again how competition comes in the low end and kills the margin very fast. So we want to be careful about where we invest. But we're always on the lookout, and accordingly we add our weightage. But yeah, we're not blindly chasing it.
Okay. And the last question for tonight is that with the de with the news with the de-dollarization, de-globalization, will the influence of US stock market and companies listed in the US diminish? And it is time again for the Asian market.
I think the de-dollarization, frankly, will take much longer than what people think. It's not so easy, actually. That's our view. Uh, I think the dollar will still remain a dominant reserve currency for some time to come. Eventually, the I guess the importance might diminish, but it's not happening, at least in the next few years. I think not something we need to worry about, at least for next few years. I think that's not going to be a big thing in the near term. Actually, I think although
Oh,
people are talking about it, it takes time. I think it's still very early days.
okay, that's it for tonight. So again, ladies and gentlemen, we hope that you enjoyed today's session and had valuable insights from Mr. Ajay to help you in your investment decisions. And thank you for joining today's webinar. And thank you, Mr. Ajay, for the session and also answering our participants' questions. If you have any further questions, feel free to drop us an email at investhelp.my@fundsupermart.com. And if you've missed out certain things from today's session, the recording of the session will be uploaded on our YouTube channel by this week, where you can actually watch the replay. So thanks again for everyone. And thank you, Mr. Ajay, for sharing your thoughts today. Thank you and have a good evening.
Thank you, everybody. Thanks for participating, and thanks FSMOne for arranging. Thank you.
Thank you and bye.